Margins also reasonably maintained. B.S. Ajaikumar, Chairman and CEO of Healthcare Global, joins us. Mr. Ajaikumar, this is a fairly strong performance. Can you take us through whether you will be able to maintain this kind of a run rate?
I think, as you said, that we had a very good quarter, and year on year we have grown well. And the demonetization effect has been very moderate for us, fortunately. And going forward, we are confident we can continue to keep this level of growth and margin. And particularly in the longer term, we have enormous opportunities for us, some new centers opening up. A significant number of centers are actually opening up this coming year. With all that, we are quite comfortable in the growth pattern we have taken, and going forward also, we are confident of the growth.
Okay. Mr. Ajaikumar, good morning. So your 9-month EPS is about 1.8 rupees. What kind of number do you think you'll be able to deliver in FY18?
Unfortunately, we don't give our forecast, but we are very confident we'll continue to deliver good numbers.
Okay. Maybe in terms of top line growth, 22% was the run rate this quarter. Is that sustainable?
The growth will be good. Again, for us, when we look at the growth with the new centers, we think the growth is quite sustainable. Particularly with the new centers coming on board.
You have 3 new centers coming in the next 6 months, right?
Yes.
And they are at?
One of the big centers which is coming up in Borivali in Mumbai itself, which is a dedicated oncology center. And then we have one big center which is about to open in Kanpur, and also a center which is also apart from that, a big center in Nagpur, which is a dedicated cancer center, which is opening. So these are the 3 centers which are open.
Will this mean, the capex mean an increase in interest costs? What is your debt at? What will it be in FY18?
See, the debt is at, as we close the quarter, it is around 266 crores at present. And when we look at the debt, we always have this vendor finance debt and as well as the bank debt, which is the serviceable debt. Because our HCG model is we have a 3-year cap on the payment for the vendor finance. So with this, our bank debt is only around 159 crores. So it is serviceable. Going forward also, for all the centers we have now in the works and most of the capex has been accounted for. So in the future will be for some of the centers, 5 new centers which are going to come up by 2018. For those the things we are now, capex has already been planned. So we are very comfortable in as far as the capex, the debt and the serviceable debt we have planned.
By when does a hospital begin to pay for itself, so to speak, become break-even for you? Does it take a year, 6 months or even more?
See, in our model, if you look at Gulbarga, for example, or even the Vizag or Baroda, all of these centers which started last year, all of them have become break-even within 12 months. So our model is they become EBITDA positive within the first 12 months. Some of them actually have become within 6 to 8 months. And we are very confident most of the centers which come will be positive within the first year. So when we look at our model, when we have the 3-year payback period where we do not have to service the high capex debt, in the 3-year period, most of these centers would have broken even and will be definitely profitable. Because of that, they'll be able to service their debt effectively.
Okay, thank you very much, sir, for joining us with all those details. It feels a little eerie to ask, will revenues go